All right. Well, terrific. This is John Richards, CEO, founder of Startup Ignition. Thanks for being here today for today's webinar. The topic is Preferred Stock Explained, What VCs Forgot to Tell You, and very much appreciate you being with us today. The purpose of this webinar and these free webinars that I'm holding is to promote an upcoming cohort of Startup Ignition, which will be happening December 11th, 12th, and 13th. There's still a few seats left. So if you'd like to apply for that, you can do that at startupignition.com. And we hold it at the Kiln Co-working Space, a 5-star co-working space in Lehi, Utah. And we'll talk a little bit more about that in just a little bit. So let's get started. So first of all, an agenda. We will have the ability to do Q&A at the end of today's session, but today's session is a little special. We're going through some material where I'm going to ask you to pause and stop me if you're not understanding it by letting me know. So we can do that. Also, I'm going to just do a little bit of street cred for myself and tell about Startup Ignition. If you've been on these before, I do that in about 5 minutes or less. And then we go into the topic of the day, which today is preferred stock. So with that, we'll get going. First of all, again, myself, I'm an entrepreneur, an angel investor, an educator in the field of entrepreneurship, and also a mentor. I've had a lot of different experiences in my venture career. Entrepreneur, I've had a company go public on the NASDAQ in the dot-com era. I've had other successes with exits. I've also had some failures. As an investor, I've done about 85 direct investments, have about 25 current investments, and have done hundreds of others through by being a limited partner in other venture funds. As an educator, I spent 12 years at Brigham Young University, where it went from unranked to a #2 ranking amongst programs in the country and the world. I was named one of the top 25 educators in entrepreneurship. I was trained at Babson College, which has been #1 for about 20 years, and have taught hundreds and hundreds of lectures and classes. So also in the field of mentoring, I have mentored thousands, not just hundreds. I was the founder of Boom Startup, and also was managing partner of Utah Angels, and with that organization for over 10 years before it sunset and has now become Utah Angels 2. And that's me. So I'm a been there, done that trainer in the Startup Ignition program. All of this has led to a curriculum that has been battle tested for more than 15 years. Now, these are some of my recent and current investments. A lot of these are in the Utah market, some are outside. And just to let you know it's real, I am eating my own dog food. So Startup Ignition, what is it? It is an intensive short-term skills boot camp covering entrepreneurship. This is modeled much after the dev boot camps that started about 7-8 years ago and swept the adult education world. And now there's many topics covered in short-term boot camps that often outperform 4-year degrees in terms of skills, training, and ability to use those out in the field. What we're looking for in this boot camp is those that want to start a company, those that are currently starting a company, and those that maybe started a company in the last year and need help. We've had companies from individuals that just are toying around with an idea all the way through, and you don't even need to have an idea, and all the way through companies with up to $1 million revenue. Another offshoot of this is that it's turned out that people that come into the program and find out entrepreneurship is not for them often find and have jobs that come to them that are superior than what they had before they were thinking of being an entrepreneur, because they now can speak the language of business and entrepreneurship and understand equity and get themselves in better positions. Now, the Startup Ignition model is all about doing the right things in the right order. It's a real big sin in entrepreneurship to do a right thing out of sequence. So when we look at the 6 phases or stages of a business in terms of its maturation, evolution, discovery, validation, efficiency, scale, sustain, and renewal. In Startup Ignition, we focus on discovering validation with our first set of curriculum and really discover who the customer is and then validate a business model around it. And Lean Startup is the skeleton of the curriculum, but we cover soup to nuts, A to Z, everything that you would need to know about and cover in the first 6 to 18 months of a venture. So We have a very organized and detailed delivery mechanism for this curriculum. This is too complex on the screen to explain right now, but suffice to say that we know what we're doing and we've done it many times. We have instructors and affiliates of the program. I'm the main instructor along with Gary Rhodes. Gary and I were among the highest rated professors of all time in entrepreneurship and business in the Marriott School of Management at Brigham Young University. Gary just retired this last December and continues to teach in our program. My son Tyler Richards took this information, went out, built Dev Mountain, sold it for 20 million 3 years in, and he shares some of his experiences as well. Eric Espinoza is an alumnus of the program who has become a master at validation, and he is doing many things in the field of validation that are exciting, and he also assists now and has handled scores of alumni of the program in their validation work. So the cohort coming up again is at Kiln in Lehigh, December 11th, 12th, and 13th. This is again a state-of-the-art co-working space. They have a great space for holding these boot camp cohorts. How much is it? It's $1,999 for tuition. There's no equity involved. And many people feel after the first day it's worth 10 times that. There's lots of reasons for that. There's discounts for multiple founders and women entrepreneurs. Again, you can go to startupignition.com and read all about it and get all the information about what we do and a list of our curriculum and what we teach and go over. Again, it's about what's under the hood, not just a pretty car. We're looking for the engine and how things are put together, and that will really get you to the checkered flag, the finish line, and an exit for your venture where your goals and aspirations will be met. That's what we're focused on, not just a pretty looking car, but actually a true working, excellent car. So the value that we bring: knowledge, mentorship, networking, and peer-to-peer interactions. Do not underestimate the value of peer-to-peer interactions, and a lot of that is happening in Startup Ignition. Matter of fact, we've had about 10 companies formed by coalescing alumni together and into a greater venture. This is our most recent cohort, held a couple months ago in the same location. And 100%, this is the first time it's happened. We've held well over 20 cohorts, and this is the first time every single participant voted us a 10. We've never had less than a 9 from anyone out of the hundreds that have taken it. And this time was a perfect score of all 10s, which was just interesting. So that's why I'm sharing it. And these are some of the comments we got from that group. You know, people promoting it to others. Changed the way they analyzed ideas, comprehensive world applicable. I have hundreds, if not a few thousand quotes about this like this, but don't need to belabor that too much. Startup Ignition, again, the good news is entrepreneurship can be taught in an entrepreneurship boot camp, and you have 3 days of initial all-day training followed by 3 months of unlimited mentoring to put into action what you've learned. So again, that's Startup Ignition, and can take questions at the end of today's webinar. Let's segue now and get into today's topic: preferred stock explained, what VCs forgot to tell you. I've never shared this training outside of an actual cohort. It's unique. Business schools do not teach this, even in master's level accounting and finance classes. So hopefully you'll find it interesting, and we'll see if it is. With that, first of all, we need to start with understanding a little bit about who you are, what type of entrepreneur you are. And if we put a continuum up here and look at risk-averse, debt-averse entrepreneurs, and then on the other side, equity conservationist entrepreneurs, these are 2 different approaches to raising capital and how we might go sell equity to investors. And so risk-averse, debt-averse entrepreneurs and equity conservationist entrepreneurs approach it differently. And anyone can be anywhere on this continuum. You might want to find out where your team as a whole would be. So a risk-averse, debt-averse entrepreneur is going to prefer dilution over debt. They're going to have concerns about paying back that debt. They're a little scared of debt generally, and they want the investor to share in the risk. An equity conservationist entrepreneur says, I'm not going to sell this equity this cheap, this early, and they avoid selling cheap. And they are showing some high commitment by selling the equity that they feel excuse me, by selling equity, by taking on debt, by feeling that this thing's going to happen. I'll take the risk of the debt and I don't want to sell it cheap. So that shows a little bit of commitment, kind of interesting. There's a lot of debate whether someone should take debt or equity, but this is just some of the approaches and the mindset of some of the folks. It certainly conserves wealth. I know one company here in Utah that had a great exit. The first 3 rounds they did were all debt rounds, and it preserved a lot of equity for the founders and owners. With that, let's overlay then on top of another continuum, which is equity methods of investment and debt methods of investment in the venture world, and take a look. There's many different types of methods of taking in investment. And again, remember this previous continuum and how they overlay. A risk-averse, debt-averse would prefer selling equity. An equity conservationist would prefer taking on debt. Now, in looking at this, as we go from left to right on this continuum, common stock is just dividing your equity and selling pieces of it. The same type of equity a founder would have, we would sell that to an investor, and that's called common stock. Nothing much special about it. It's transacted in a common stock sale and purchase agreement. Preferred stock is the next one going over from the left. It is equity, and preferred stock has certain preferences over common stock. That's where the name comes from. And we're going to explain that in detail, which is the subject of today's webinar as we get into it in just a few minutes. About half of all venture investment is done with preferred stock. So that may be 40%. And it's important that entrepreneurs understand this mode of investment, because all institutional investors invest via preferred stock. Are there exceptions somewhere? Yes, but very few. Convertible equity, a new invention recently in the last 5 to 7 years called a SAFE, or Simple Agreement for Future Equity, is very popular with Y Combinator and the crowd out in Silicon Valley, and it's crept into other markets here in Utah as well. And this is very much like convertible debt, but it's convertible equity because there's no recourse like there would be on debt. And so it's called a Simple Agreement for Future Equity. Now, I prefer over SAFE the KISS equity and the KISS debt documents. This was invented by 500 startups and is an answer to the SAFE note that is a little bit not enough protecting of investors. And so the KISS equity, which is keep it simple security, and the KISS debt are ones that I personally prefer. Matter of fact, my last 6 venture investments have all used the KISS debt instrument. Convertible debt is a very popular 40% or so of all venture investments done with convertible debt. And this is just a loan that starts off as a loan, but will convert at some trigger to debt, or excuse me, to equity. And many of you are probably familiar with that. And then we go over to venture debt, where it's an actual amortized loan that rewards the investor with some warrants for making the loan, and then revenue-based lending, which was popular about 5 to 10 years ago, which is not done that much as in this market here in Utah, at least very much, and then straight debt. So with that, looking at this spectrum, let's dive now into looking at, in a cap table and different rounds of investment, what type of which of these would be used in which rounds. So in a founder's round, as you familiar yourself with this illustrative cap table, would be using common stock. In a friends and family round, we would have common stock and often convertible debt as well. As we get into taking money from angel investors, we could see common stock, convertible debt, and preferred stock. Sophisticated angels will press more for preferred terms, but many will also go for convertible debt to avoid the discussion of the value of the company. Some might take on common debt if it's early and cheap enough stock. Seed round, preferred stock. So if you're going with an institutional seed investor, which is what this is talking about, you would be looking at preferred stock. Same for the venture capital round. For a full venture fund is going to be investing in it via preferred stock. And then back to the IPO, we would be back to common stock. So that's a traditional look at how things work. Let's really dive now into preferred stock. So preferred stock is interesting. Paul Allen, the founder of Ancestry here in Utah, gave a talk one time at Brigham Young University and called it the single most important lesson I learned the hard way. And he was talking about the day that he learned the difference between preferred stock and common stock. Now, in taking a look at this and what you'll learn here in just a few moments, you'll start to understand why he said that. So preferred stock is governed by a preferred stock purchase agreement. In this purchase agreement, the entrepreneur and the investor are coming to terms in a contract of how the investor will purchase ownership in the company and what the terms governing that ownership will be. The reason it's called preferred stock is because it has preferences over common stock. Common stock, again, is the type of equity owned by founders and early investors. The preferences are important, and there's probably about 60 different preferences in an average preferred stock purchase agreement that are given to preferred stockholders. And these are important to understand. In today's presentation, I'll go over about 5 or 6 of them. I'm not going to go over all 60, though I could do that. Take me about 5 hours and you'd probably be entertained, and I could keep you entertained on the discussion. We go into them a little bit in greater detail, of course, in the full boot camp. The first preference, and the most important one, is called the liquidation preference. This is the preference given to preferred stockholders where they get preference when the company is liquidated. Whether it's a positive or negative liquidation, whatever money is available to be issued to equity holders, a preference is given to preferred stockholders. And we refer to it in terms of 1x, 3x, example 1x, 2x, 3x, 1 times, 2 times, 3 times, and that is applying to dollars, not shares. So if an investor invested $500,000 in a company and there was a liquidity event and he had preferred terms giving him a 1x liquidation preference, he or that group would get 1 times their dollar investment back before any other equity holders get a penny. In that example, that would be $500,000 coming off the top. Now, the second liquidation preference that's important is called the conversion right. The conversion right is about how many shares of common does a preferred share become upon conversion. And there's triggers to conversion. A liquidity event can be a trigger to conversion. There can also be at the discretion of the investor to convert at any time he, she, or the group prefers. These are also expressed as times multiples, for instance, 1x, 2x, all the way up to 10x. So these conversion rights are important to understand. There are 2 types of preferred stock, and it's not on the slide deck here. One is called participating preferred, and the other is called non-participating preferred. Most common or preferred stock you will see in the marketplace is participating preferred. This is where the investor gets to participate as a preferred stockholder and get all of those rights, and then also is able to convert to common once all those rights have been met, and becomes common stock and participates then along with the common in sharing the rest of the money. I'll explain this in detail in just a minute. These 2 rights together create a 1-2 punch that are very powerful in favor of the investor. So the conversion rights, again, come along and play a very important role when there's participating preferred. When we talk about a preferred stock deal and we say, what kind of preferred stock terms did you get? We would say, I got 1x, 1x. That means I got 1x on liquidation preference and 1x on conversion rights. There's good news that in today's pro-entrepreneurial environment, most deals are 1x, 1x. But we'll show you examples done when they're not just 1x, 1x. So the third most important, in my opinion, is board seat configuration. In the preferred stock purchase agreement, we'll spell out a mandate that the company is agreeing to. So this contract of selling preferred stock is not between the individual founders and the investors. This is important to understand. It's between the company and the investors because the company is issuing new preferred stock to those investors. So the company is agreeing to many things, and one of them is board seat configuration. This is very, very important. You, as an entrepreneur, would want a 3-2 board where 3 seats are voted in by the common stockholders and 2 are voted in by the preferred stockholders. A majority of the preferred get to vote in too. If you do this, you will keep control of your company. But the preferred stockholder is going to want you to go to a 2-2-1 board, which means 2 positions voted in by common, 2 voted in by preferred, and 1 appointed by the 4 existing board members, a neutral, supposedly neutral board member. This is where an entrepreneur loses control of his company potentially. If a 2-2-1 board is put in place, it's very common, well, I shouldn't say very common, it's not uncommon, that a year or so after this investment, the CEO founder is under pressure for non-performance and could be threatened with losing his job at his own company by the board voting him out as CEO. This happens about 3 times a year to people I know when they've taken on preferred stock investment. So one of the things you're going to want to argue for is to keep a 3-2 board. If you give up and go with the 2-2-1 board, which there'll be immense pressure to do, you should be getting concessions on other points in this deal. Now, moving on, the fourth set of very important preferences is first right of refusal and preemptive rights. First right of refusal is where the preferred stockholders get pro rata rights to acquire any shares of stock being put up for sale by any other shareholder. So if one of the 3 founders decides to sell their 10% ownership in the company, the preferred stockholders get to purchase those shares above anyone else. Even if the preferred share or the common stockholder, the founder found a great person to buy that stock and get involved in the company, the preferred shareholders could take that same deal. So they usually have 10, 20, or 30 days upon which to make their decision to step in and take the purchase away from the would-be acquirer. Now, the preemptive rights are virtually the same thing, but have to do when the company is issuing new shares, preempting the issuance of new shares to an outsider or another shareholder. So if the company goes and opens up a new round of investment and wants to bring in another investor and sets the terms on those shares, the existing preferred stockholders can preempt that transaction and purchase those shares themselves. These rights are very important. Any venture investor that knows what they're doing will get these rights and would not do a deal without these rights. So it's going to be very hard for you to get these rights out of the deal. This is how investors acquire and double and triple down into companies, and acquire stock from tired investors and buy them at discounted rates and acquire and accumulate stock before an exit. So very important term. Number 5, protective provisions. There's a paragraph in every preferred stock purchase agreement called protective provisions, and built into one paragraph that may run literally in 2 columns for 3 pages. Yes, in one paragraph, there will be a listing of sometimes greater than 20 protective provisions granted to the preferred stockholders. So these are sometimes thou shalt not give any manager a raise greater than 4% per year. Thou shalt not incur indebtedness greater than $25,000 without the majority approval of the preferred stockholders. Thou shalt not write a check for greater than $20,000 without approval of the preferred stockholders, and many other provisions along those lines. And there's many more. All right, I'm going to take you in the couple minutes we have left through a couple of examples of how this works. If we have a company, ABC Incorporated, and it does 4 million founder shares, common stock, and then sells 1 million preferred shares to investors at 50 cents a share, the total outstanding shares in the company are now 5 million. What percentage do we sell the investors? Well, looks like 20%. So let's take through some liquidity events, exits, and see how this works. Sample 1, liquidation preference is a 1x, conversion preference is a 1x. There's a quick $5 million acquisition 2 years into the company. We took this money, let's say, at 9 months. So an acquisition is done for $5 million. How much goes to the preferred shareholders for their liquidation preference. Well, they get 1 times the amount of money they put in. 1 million shares at 50 cents is $500,000. So off the top of the 5 million would come $500,000. How much money is there to divide between the common shareholders then? Well, 5 million less 500,000 is 4.5 million. Now, how do we divide this between the common shareholders? We've taken care of the preferred shareholders. They got their liquidation preference, but they're participating preferred. So there's 4 million common founder shares, and there's 1 million preferred shares that now have to become common. And how many will that be? Since it's 1x, they will become 1 million common shares. That means now there is how many common shares? 5 million. 4 million from the founders, 1 million from the preferred shareholders. How much is owned by each? Well, the preferred shareholders own 20% and the common shareholders own 80%. So we split the 4.5 million that way. The preferred shareholders get 900,000, the common shareholders get 3.6 million. What is the total outcome? Well, we have 500,000 plus 900,000 to preferred shareholders, which is 28% of the total, and 3.6 million, 72% of the total. So in reality, we thought we sold them 20%, but we actually sold them 28%. We don't discover this till years later after signing that big stack of paperwork. Now, let's look at sample 2. Liquidation preference 2 times. Conversion preference 3 times. Well, how does this work? Let's take a look. Acquisition for $5 million would look very different now. How much to the preferred shareholders for liquidation preference? Well, they get 2 times their 500,000, so they take $1 million off the top. How much is left to divide then? 4 million between the common. How do we divide it up? Well, there's 4 million founder shares, but how many commons are now created from the conversion of the preferred shares? Well, preferred shares become 3 million shares because they have a 3x conversion preference. By the way, as a footnote, in my career, one time I had a 1x, 3x deal in my greatest angel investment ever, and it rewarded me very handsomely. How many common shares are now existing? Well, 7 million. 4 million plus 3 million is 7 million. So there's how much money to divide up? 4 million divided by 7 million. So the preferred shareholders now get 3 million, 43%. Common shareholders, 57%. What's the total dollar outcome? Preferred shareholders get 1.715 of that common split, and common get 2.285. The grand total outcome is the preferreds get their 1 million off the top, the 1.715 million for a total of 54% of the deal, and the common shareholders get 46% of the deal. We thought we sold them 20%. So would a venture capitalist really carry through and do this to you? Are they pirates for doing so? No, they're good business people that struck a good deal, and they would have to do this to you because they have a duty, a fiduciary duty to their limited partners in their fund. So they will do this to you. And that's just how it works. So that is preferred stock in a nutshell. We got started a couple minutes late, so we're still under our 30-minute time frame for today. But that is how it works, and that is preferred stock. Do you have any questions about preferred stock? Unmute yourself and ask if you'd like, or you can do it in the chat if you'd like to ask any questions. While you're doing that and thinking of those questions, I'll just remind you that you're invited to apply for the Startup Ignition Bootcamp, December 11th, 12th, and 13th. And I'll also put up my contact information. I'll take any questions from you by email, jrichards@startupignition.com. And remember, we have discounts for teams and women. All right, any questions on preferred stock? Go ahead. Doesn't look like there's any coming in. If that's correct, I'll give 10 more seconds for anybody to ask a question or pop off. No questions. All right, question. Terrific. Thank you for saying it was awesome. Appreciate that. I hope you enjoyed it. And that explains preferred stock. And now you know that the other side of the table when you're negotiating with a venture capitalist, eat, sleep, and think this, and now you're more ready to deal with that negotiation. Thank you for your time, and we'll now adjourn the webinar. Thank you.
I was talking to the microphone.